Hello everyone and welcome back to the Fortune Signal. On April 2, 2025, President Trump announced new tariffs that could significantly impact your investments. A 10% tariff on all imports began on April 5th, with rates as high as 49% on nations like China starting April 9th. Wall Street just witnessed its biggest meltdown since 2020. As of today, the S&P 500 has crashed over 5%, wiping out nearly $3 trillion in a single day. The Nasdaq plunged around 7%, its worst drop in 5 years. The Dow? Down nearly 1,900 points. This isn't just a dip, it's a financial earthquake. Is this the start of another 2008-style crash? All of it triggered by Trump's surprise tariff threat, igniting fears of a global trade war. Stick around to see how this could hit your portfolio next, and what to do before it's too late. If you're a hardworking individual trying to build wealth, this is your moment to act. These tariffs could disrupt your financial plans, but have strategies to help you safeguard your money and even find opportunities. Hit the like button if you're ready, subscribe, and remember this video is for educational purposes only and is not financial advice. President Trump's America First policy is in full effect, targeting over 100 countries: China, the EU, the Great Britain, India, with that 10% tariff. Mexico and Canada receive some relief under the USMCA, but China faces a 54% rate for unfair trade practices. China is preparing to retaliate, potentially targeting U.S. agriculture, while the EU and Canada may focus on exports like whiskey and machinery. A global trade war could be on the horizon, putting your investments at risk. Stay with me. I'll guide you through the steps to protect your portfolio. Experts predict that 10% tariff could increase U.S. inflation by 0.5% to 1%. The Federal Reserve, currently holding rates at 4.25% to 4.5%, plan to reduce rates to just over 3% by year-end. However, if inflation surges, they may pause those cuts, slowing economic growth to 1.8%. If China or the EU retaliate, U.S. companies reliant on exports could face significant losses. The technology sector, in particular, is entering a difficult period, as rising tariffs add pressure to an already uncertain global environment. Companies like Apple and Nvidia, which earn 57% of their revenue overseas, saw their stocks drop sharply since the tariff announcement. Their reliance on Chinese supply chains means higher costs. The auto industry is also at risk. Ford and GM are concerned, even with USMCA exemptions, as many components still face tariffs. Export-focused companies like Boeing and Caterpillar are vulnerable if Europe or China retaliate. Stay tuned. I'm about to reveal the #1 sector to invest in right now, and it's a game changer. There are opportunities if you know where to look. Domestic manufacturing could see a surge. Smaller US-based companies in the iShares Russell 2000 ETF, IWM, may benefit as imports become more expensive. Healthcare is a safe haven. The Healthcare Select Sector SPDR Fund, XLV, is not tied to global supply chains, ensuring stability. The Utilities Select Sector SPDR Fund, XLU, offers steady dividends and low volatility. Energy stocks could rise with increased domestic production. As a short-term investment strategy, focus on defense. Choose the safest path. Leave your thoughts in the comments. Healthcare, utilities, or manufacturing? What's your choice? Let's discuss strategy. Diversify immediately. Reduce exposure to companies heavily reliant on global markets, such as tech giants with overseas revenue. Focus on US-based firms. iShares Russell 2000 ETF, IWM, includes smaller American businesses that could thrive under tariff protections. Defensive sectors like healthcare, utilities, and consumer staples are essential. If you're ready to take these steps, hit the like button. It signals the algorithm to bring you more strategies like this. Inflation protection is critical. A 0.5% to 1% price increase may seem small, but it adds up over time. Protect yourself with Treasury inflation-protected securities. The iShares Bond ETF, TIP, adjusts with inflation. Tariffs drive prices up. That's inflation. But gold, it rises too. SPDR Gold Shares, GLD, moves with gold prices, making it a smart hedge when inflation kicks in. Real estate, through the Vanguard Real Estate ETF, VNQ, benefits as rents climb. Gold is a reliable hedge against the inflation. SPDR Gold Shares, GLD, rises as prices increase. Real estate, through the Vanguard Real Estate ETF, VNQ, Benefits as rents climb. As markets pull back, it creates a strategic window to invest in high-quality companies at a discount, particularly in resilient sectors like healthcare, utilities, and leading U.S. manufacturers. For long-term investors, volatility often unveils opportunity. Here's the bottom line. Trump's tariffs aim to strengthen U.S. manufacturing, but they bring challenges: inflation, global retaliation, and market turbulence. However, with the right approach, diversification, defensive sectors, and inflation hedges, you can protect your wealth and position for long-term gains. Subscribe, hit the bell, and stay prepared. I'll share more smart money strategies in my next video. Let's secure your financial future. See you soon.